In this module, we're going to tame the messy real world by grouping it into clear on-chain buckets. You'll see how treasuries, private credit, real estate, and more each become distinct RWA primitives with very different risk, liquidity, and yield profiles. Real-world assets are essentially on-chain wrappers around off-chain economic value. A token becomes a claim on something that lives in the real world: a bond, a loan, a building, or a stream of revenue. Instead of chasing purely speculative emissions, you're plugging into existing cash flows and legal rights, accessed and composed through crypto rails. RWA opportunities sit on a spectrum, not in a single bucket. On the safer end, you have things that look like on-chain cash accounts: treasuries, money market funds, investment-grade bonds. Lower yield, but strong legal backing and liquidity. In the middle, you move into SME loans and trade finance. Yields rise, but you're taking targeted credit risk. At the far end are frontier bets like tokenized real estate or royalties. Hardest to value, most upside, and the most ways to go wrong. Tokenized treasuries and bills are crypto's primary entry point into real-world assets. They wrap short-term government debt, giving you on-chain access to off-chain, low-risk yield. Each token is a claim on actual securities held by a regulated custodian, with clear legal rights. This blend of safety, liquidity, and familiarity is why they've scaled first. Money market funds act like tokenized cash parking lots. They hold short-term, high-quality debt, such as T-bills and commercial paper, targeting very low risk and low volatility. For crypto users, the draw is daily liquidity inside an institutional wrapper. You can think of them as on-chain cash equivalents, issued by big names and accessed through compliant KYC-gated rails. Now let's look at the basic pipeline that turns boring. Off-chain debt into plug-and-play DeFi building blocks. Step 1. A real-world asset goes into a legal wrapper like an SPV or trust, so investors have enforceable rights. Step 2. That wrapper issues tokens, which represent claims on the underlying collateral and its cash flows. Once tokenized, those claims can slot into lending markets, yield strategies, and bespoke liquidity pools, while adding new layers of counterparty, custody, and oracle risk you have to evaluate. Corporate bonds are one of the cleanest ways to see this RWA logic in action. Off-chain, a company issues a single $10 million bond. On-chain, that same exposure becomes many small positions anyone can buy or sell. The result is fractional access, 24/7 liquidity, and real-time portfolio tracking. Risk usually sits in the low to medium band with moderate yield, but only if legal structuring, disclosure, and KYC AML are handled correctly by platforms like Ondo or Maple. Private credit and supply chain finance are essentially tokenized business loans. Imagine a company with a $100,000 invoice it doesn't want to wait 60 days to collect. It sells that invoice at a discount, and DeFi liquidity steps in to front the cash. When the customer finally pays, investors receive principal plus interest. The core risk is buyer default, so platforms lean heavily on underwriting, KYC, diversification, and over-collateralization to target medium risk with higher yield. Structured credit pools take those loans and layer the risk. Picture one big bucket of loans sliced into different tranches. Cash flows from borrowers first fill the senior tranche. Senior lenders are paid back first, so their risk and their yield are both lower. Whatever remains spills into the junior or equity tranche. That junior side takes the first loss when borrowers default, but earns the extra yield when things go well. Tokenized real estate is basically REITs meets DeFi. There are two main flavors. Equity-style tokens give you a proportional slice of an SPV that owns the building. You're exposed to rental income and to the property's price going up or down. Debt-style tokens sit on the lending side: mortgages, mezzanine loans, or revenue share notes secured by the property. These often pay more predictable coupons, but you take on default risk, foreclosure timelines, and the quality of legal enforcement in that jurisdiction. From property, we move into frontier RWAs, tokenized revenue streams. Here, you're not buying equity. You're buying a slice of future cash flows. That could be a capped percentage of a startup's revenue, or a share of music and film royalties. Smart contracts then route those off-chain payments on-chain, usually as stablecoins, creating high-risk, high-yield income tokens. Beyond treasuries, credit and real estate, some teams are tokenizing truly exotic assets. Think carbon credits, patents and software licenses, or even slices of lawsuit payouts. These can offer returns that don't move with the rest of your crypto portfolio. The trade-off is serious. Messy valuation, complex legal enforcement, and very noisy. Hard to trust Oracle data. Each RWA bucket really competes on a different axis. Government debt focuses on low credit risk, strong liquidity, and clear regulation. Yield is the least interesting part. Corporate and private credit dial up risk and legal complexity to buy more yield. Real estate trades away some liquidity and simplicity in exchange for hard asset backing and moderate spreads. Exotics and revenue streams flip the script on treasuries. They're messy and less clear, but offer potentially very high, uncorrelated returns. You can think of RWA strategy as a pyramid you actually build on chain. At the base are treasuries and money market funds. Boring by design, ideal for protocol treasuries, collateral, and parking stable liquidity. Above that sits corporate and private credit, which powers higher yield vaults and channels capital into real businesses. At the top, you layer in real estate and revenue streams for differentiated, uncorrelated upside. The key idea: these are not silos. They're composable Lego bricks for a unified financial stack. Erwatia adoption tends to follow a three-step trajectory. Step 1. Protocols earn trust before chasing yield. Treasuries and other low-risk assets dominate early, proving that rails, custody, and legal plumbing actually work. Step 2. Once that trust exists, the frontier expands. Capital rotates into private credit, emerging markets, and more experimental structures, searching for extra basis points. Step 3. The long-term end state is a composable menu of risk. You'll dial in risk, duration, and liquidity the way you swap between DeFi pools today.